Imagine a silent war being waged for control over the base layer of the world's most important cryptocurrency. For months, BlackRock has been the undisputed king of the Bitcoin ETF market, hoarding over $52.7 billion in assets under management. But a new regulatory filing has just revealed that another Wall Street titan is preparing to launch a direct assault on that empire. And their strategy threatens to completely monopolize the remaining liquid supply of Bitcoin. My name is Guy, and you're watching The Coin Bureau. So then, why is Morgan Stanley suddenly building its own native Bitcoin infrastructure? Is this the ultimate validation of the digital gold thesis? Or is Wall Street preparing to completely centralize the underlying supply of a decentralized network? Before we get into all of that, though, let's look at the filing that just sent shockwaves through the institutional crypto space. On the 4th of March 2026, Morgan Stanley officially filed a critical amendment to its spot Bitcoin ETF application with the SEC. The mainstream financial press covered this as just another late entrant to an already crowded ETF market. They pointed out that BlackRock's IBIT already dominates the space, commanding nearly 60% of all US spot Bitcoin ETF assets. The surface-level narrative is clean and simple. Morgan Stanley manages roughly $8.2 trillion in client assets, and they're simply trying to capture a few basis points of management fees from their wealthy clients instead of routing them to BlackRock. But if you read the actual architecture of their proposal, they're planning something much more aggressive. And let's be precise about what is actually happening. The amended filing reveals a dual custody model. Coinbase custody will handle the on-chain security of the Bitcoin in offline cold wallets. Meanwhile, BNY Mellon, the 200-year-old traditional banking giant, will handle the cash administration and transfer agency. Now, Morgan Stanley is not just launching a fund. They're attempting to build a closed-loop ecosystem. Unlike other wealth managers who simply allocate client capital into BlackRock's IBIT, Morgan Stanley wants to own the entire stack. And to understand why this matters, you have to look at what they just filed 2 weeks prior. On the 18th of February, Morgan Stanley applied to the Office of the Comptroller of the Currency for a national trust bank charter. The proposed entity is called Morgan Stanley Digital Trust, and it's not just a regulatory box-ticking exercise. The firm's head of digital asset strategy, Amy Oldenburg, publicly declared that they are building native custody and exchange infrastructure. Her exact words were that Morgan Stanley can no longer just rent the technology from third parties. And here is how it works. Right now, the entire US spot Bitcoin ETF market relies almost exclusively on one company. Coinbase acts as the custodian for over 80% of the assets within these institutional vehicles. If multiple trillion-dollar asset managers all rely on the exact same crypto-native custodian, you get a massive concentration of systemic risk. Morgan Stanley is deliberately preparing to bypass that Coinbase-dominated custody monopoly. By securing a federal trust charter and building their own native vaults, they're positioning themselves to directly hoard base layer Bitcoin on behalf of their clients rather than relying on third-party custodians. They are building the back-office plumbing of blockchain finance entirely in-house. And speaking of staying ahead of these massive institutional power plays before they hit the mainstream headlines, this is exactly why you need the Coin Bureau Telegram channel in your life. This is where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so you don't miss a thing. Whether it's a hidden SEC filing or a major shift in ETF flow data, our members see it first. So sign up today using the link down below or by scanning the QR code on the screen. All right, now back to the vaults, because the implications of this infrastructure war are profound for the actual price discovery of Bitcoin. Analysts project that Morgan Stanley's aggressive entry, combined with their massive retail distribution network through E-Trade, could push total US spot ETF assets to $220 billion by the end of 2026. But to understand the true scale of that number, we have to look at the maths of Bitcoin's liquid supply. There are currently roughly 19.97 million Bitcoin already mined. But according to blockchain forensics, between 3 and 4 million of those coins are lost forever. Furthermore, Glassnode data shows that approximately 13.5 million Bitcoin are held by illiquid entities who simply refuse to sell. That leaves a freely tradable float of roughly 3.9 million Bitcoin. And the mining network only produces 450 new Bitcoin per day. When multiple trillion-dollar asset managers like BlackRock and Morgan Stanley begin competing to custody the base layer, you get a structural supply shock. And we've seen this exact scenario play out in traditional finance before. When the SPDR Gold Trust, or GLD, launched in late 2004, it completely transformed the investment demand for physical gold. The price of gold surged nearly 287% over the following 8 years as institutional vaults absorbed the available supply. Bitcoin is currently experiencing that exact same financialization process, but on a mathematically strictly scarce asset. This is undeniably bullish for the price. But here is the bitter irony at the center of all this. This historic supply shock means that the vast majority of Bitcoin's future liquidity will be locked inside regulated, Wall Street-controlled vaults. If you control all your keys, it's your Bitcoin. If you don't control your keys, it's not your Bitcoin. Simple as. The decentralized peer-to-peer network is quietly being transformed into a traditional banking reserve asset. So, Morgan Stanley's entry into the Bitcoin custody and ETF space is not just a late grab for management fees. It's a declaration of war against BlackRock's dominance. It's a strategic move to secure direct ownership of the underlying asset and control the plumbing of digital finance. The institutional adoption phase is over. We are now in the institutional monopolization phase. And while this fierce competition will undoubtedly drive massive capital inflows and create a historic supply shock, the cost is the rapid centralization of Bitcoin's physical custody. Wall Street is no longer just adopting crypto, but building the vaults to lock it away. And I'm not sure that's what Satoshi had in mind all those years ago. But what do you think? Is Morgan Stanley's push into native custody bullish for Bitcoin's price or terrifying for its decentralization? Let me know your thoughts in the comments down below. And if you want to understand exactly how BlackRock's ETF plumbing works behind the scenes, well, you could check out our deep dive right over here. Thank you all so much for watching, and I'll see you again very soon. This is Guy, signing off.